with that, welcome back to the Attic Hour Podcast, episode 40 something. I don't know.
Upper 30s.
Upper 30s. We're not at 40 yet.
I have no clue.
I know we started in October of last year, so we got to be approaching that. We got to have some sort of celebration or something. But anyway, our guest this week is Kaden Bussel. Welcome, Kaden.
Hey, thanks for having me, guys.
Yeah, for sure. Kaden, would you mind telling us just a quick rundown on where you are or who you are?
Yeah, a little bit about me. Bluffton native, grew up here my whole life. Was actually born and raised in Ossian, but then moved out to the Craigville area whenever I was pretty young. Went to Norwell High School, graduated COVID year.
Nice.
2020, so half a senior year was spent at home. And then, went to PFW for college, was there for 3 years. And then, graduated there with my bachelor's in finance. And now I currently still live in Bluffton. My wife and I have just been married over a year last month.
Congratulations.
Yeah,
Nice.
Thank you. We made it.
Yep.
It's crazy how fast it goes, but at the same time, it feels like we've been doing it forever. We live in Bluffton and just the two of us. So I work at Strategens Capital as a financial advisor. I've been there for 5 years total. I was there for 2 years as an intern, and then 3 years, coming up 3 years here in December full time.
Okay.
So it's been a journey. It's
Nice.
been fun.
Where's that at?
Yeah, so I primarily work out of our Bluffton location, and we also have an office in Fort Wayne. Our headquarters, or our largest office, is in Van Wert, Ohio, and then we have an office up in Morris, Minnesota, and then we're starting to build an office over in Paulding, Ohio, and then we have a remote office, which will probably be a location in the next year or two in Richmond, Virginia.
Wow.
So
Okay.
yeah, starting to grow.
Expanding.
Yeah, for sure.
Mm-hmm.
We've
That's
got a
exciting.
really good team, a pretty young team, but a good leadership group, and they encourage growth and they encourage entrepreneurship, and it's been great.
Yeah,
So.
that's awesome. What kind of led you to deciding you wanted a career in finance, or what intrigued you, I guess, about it?
Yeah, I would say when I was a senior in high school, I didn't really know what I wanted to do. COVID didn't help. All I cared about was playing baseball and hanging out with my buddies. And then when those two things pretty much got taken away, God kind of allows you to sit in your thoughts, which I think He encourages us to do often, and I just kind of played out what the next few years looked like, and realized I wasn't going pro for baseball, so I wasn't really going to pursue it in college. So I told my mom I didn't want to go to college because I didn't really know what I wanted to do. I was going to go the real estate agent route because that's what I just seen on, I think TikTok was just starting to get big at that time. I had seen a couple people on there. I was like, I'll give it a try, and she didn't like that. She told me, she's like, you can do it, but you're also going to go to school as a backup plan. She's heavy education, loves the I wouldn't say the education system, but she's a big advocate for it.
Okay.
She's a teacher
Yeah.
at Kingdom Academy, obviously, and a lot of her professional development was in college. So she told me, like, hey, I don't care if you use your degree or not, just have something to fall back on. So I didn't apply to college and bought the real estate course, and was going through it that summer and realized I don't think this is for me. So applied to a few different schools. They weren't taking, or they were still taking SAT scores at that time. So I applied to Purdue, Ball State, PFW. I got waitlisted at Purdue. They accepted a ton of people. It was also that 2021 class 2 that you didn't have to take your SAT to get into school. So they accepted a ton of people. And you probably don't notice it now up at PFW, but whenever I was a freshman, sophomore, junior there was a ton of kids that had gone to Purdue for like a half a semester, and they realized they didn't have a place for them to like stay. So they sent them to other Purdue campuses around the U.S.
Oh,
Yeah.
wow.
Because like my brother graduated in 2021 from high school, he didn't have to ever take an SAT.
That's crazy.
Because of COVID, they just didn't require it. Then they over accepted. So I got waitlisted at Purdue. They said I could come if I wanted to change my major. it just didn't entice me. I had my heart set on going there. I had an apartment set up, was paying renter's insurance on it already.
That's bad.
Hey, it didn't work out. It was for the best. Still a big Purdue fan. A couple of my buddies went there, so I got to enjoy it. Yeah, and then decided to go the PFW route and commute for at least a year. I just saw what student loans looked like for me, and it just didn't make sense in my head. So I went there when I started there. I had no idea what I wanted to do. Was just going because some of my buddies, close friends, actually ended up going there, so we had a good group there. Will Fechter, Hayden Craighead, some other buddies from school, and yeah, so it was about my sophomore year. I'm like, okay, well, the one class I hated the least in high school was our personal finance course, which even then it wasn't too great, but it was the least of the evils. I liked math. I didn't like crunching numbers, but I liked interpreting data, and I just like personal finance and investing. I think it's not taught in school, which still blows my mind.
It's still not. It seems like
It doesn't make
it's
any
not.
sense.
And I don't know if it's this governmental system that they try to suppress people from knowing, hey, how do you do your taxes? What does it look like to actually go the right route so that they can keep having these people take out student loans, owe the government a bunch of money, pretty much just go into this system, right? So I just
buy now, pay later. Just all that.
My grandpa Frieden, who lives out in Kansas, he's one of the most interesting humans you'll ever meet. He lives out on a ranch in the middle of nowhere, 15 hours from here, and he farmer, rancher, but was a mechanical engineer for Boeing for 20 years. Commuted an hour and a half each way, so 3 hours total to Wichita.
Oh my!
To build planes for Boeing, and he was the one that pretty much got me into investing. When I wish it would have been earlier, but probably around 20. He was early in on NVIDIA.
Wow.
He was an early investor in Amazon. So he was just hearing him talk about it, just kind of seeing the way he went about things, kind of was like, you know what, I have a lot of interest in this. I would like to pursue this further. So yeah, just a little bit of those things. Was like, well, we'll try finance. At first I was going for finance and accounting. Realized I didn't really have a personality for accounting. I wish maybe if I would have gone back, I would have maybe paid a little bit more attention to accounting. It's a really good foundation to have, but yeah, went through the finance route, did some economics in college, and didn't like the corporate finance classes at all.
Okay.
I don't know. Your major is probably in engineering?
my major is electrical engineering.
What's your engineering?
I'm accounting.
Accounting?
Yep.
Seth?
Information systems.
That makes sense. Your dad's a computer guy, right? Okay. Yeah. So all three incredibly great pieces of paper to have and things to study. So I commend you three for that. I think those are three fields that, I mean, we have a lot of all this people talking about AI's taking over, taking jobs. It's a tool. I think it's an incredible tool, but it's not. You still need humans to tell
People
it what
are
to do.
hiring back engineers they fired now.
Exactly. Yeah. And if I was an engineer that got fired for it, I'd require double.
Yeah.
Well, maybe, but
If you
it's nice to have a job.
It is.
But you still have to tell it what to do. It's still missing a human aspect of it, which is super crucial. Still makes mistakes. I see it make mistakes often. So, yeah. Long story short, that's kind of around the bend, but that's how I chose finance, and thankfully with high school credits got out of there in 3 years. So,
Nice.
But yeah, great campus, Purdue degree, learned a lot. So
Yeah. When you said your uncle got you into like investing, you're just saying like the stock trading
yeah,
mostly, like.
my
What-
grandpa, yeah.
Yeah, what all investments do you kind of is that mainly your focus, is like trading stocks, or what other avenues of investing do you go down?
Yeah. So early on in college, when I was pretty much told, hey, you can either come to West Lafayette and change your degree and take 2 more years to take 5 years to get a 4-year degree and spend all the money, I was like, nope. And I had some money saved up because I was working at the time for Strategents as an intern, and had cash in the bank and that I was going to use on tuition at Purdue. And I remember Hayden and I were driving one day, and I'm like, hey, do you just want to buy a duplex? Had no thought into it, had never done it before. No one in my family had really an experience. I just had been seeing things that, hey, there's this, what's this house hacking thing? And what does it mean to buy a duplex, live in one side and rent out the other? What is that like? So he was kind of in the same boat as me. He was working at Honegger Ringer, and he's like, let's do it. So we looked at a few houses in Fort Wayne, didn't really find anything, and a guy I was working for at the time, on the side, I was kind of split between two jobs. His uncle or his grandpa had a duplex, needed a lot of work, was on Wabash Street, and I already had a renter upstairs, no one downstairs, and we threw him a price, and he took it. So we now had a piece of real estate that we had no idea what we were doing. We had to become landlords, which we had no idea what we were doing, and we had to remodel this place so we could live in it, which we had no idea what we were doing. So, it was I don't know how we did it. It was a super hectic time with finals, working, and also remodeling. We remodeled the downstairs of it in like 6 months, 7 months, with the help of my father, which I'm super grateful for. He's very talented in that area. So we gutted it, remodeled it, and moved in. And so, that was like my real first investment, I would say, to that extent. I had messed around with a few stocks in college, or not college, in high school. But you really can't do much until you turn 18, really.
Right.
So Robinhood had just come on the surface when I was a junior. And then senior year, whenever COVID hit, it was funny. I found an old tax return from like 2021, and I was going through all my trades, and I was a senior in high school, and it was just cracking me up. Super early. There was some in there I wish I would have never sold. There was some good ones in there, but it was just funny to see kind of. It was a lot of those Norwegian cruise line stocks that because COVID had hit them so hard.
Oh, yeah.
Boeing, Norwegian Cruise Line. I bought some of that, and then also bought into Pfizer and some of those pharmaceutical companies that were then ramping up due to the vaccinations and things of that nature.
It was probably a good thing that you pulled out of Boeing, like, right? I'm guessing that tanked.
Yeah, it had. Well, I bought in when it tanked.
Okay.
But I mean, we're talking like less than $1,000 in each position. It was just pretty much all I had at the time, just to try it out. I think that's one of the best ways you can learn, is just experimenting yourself. So I had messed around with that a little bit. Meme coins had started to like come on the scene. Remember my brother, I don't even know how he opened an account because he wasn't 18. Or maybe it was just a paper account. But he was getting into Dogecoin pretty heavily, and all those meme coins.
Yeah.
And I had bought some AMC because it was whenever GameStop and AMC were on their meme runs.
Okay.
I don't know if you guys know about that at all.
No, I don't.
Yeah, I've heard of that.
Yeah, so it's based on a true story. Around COVID time, 2020, 2021, there was, GameStop obviously was just being crushed from a stock standpoint, business standpoint, because everything's online. Why would I go in, rent a DVD or a movie or even a video game, really, when you can just buy the digital version?
Right, makes sense.
And so Reddit at this time, I don't think it was being used too heavily for like a display of opinions on investing. And this guy, I think his name was Roaring Kitty or something like that. He comes on the scene. He had dumped like $100,000 into GameStop, and like would live stream and podcast like, hey, they're a good company. They don't have a lot of debt. They're from like a technical analysis standpoint, there's no reason why this stock should be tanking. And so if you go out 5 years,
If it loads,
or even max, it looks. Yeah. So right there.
Wow.
So, it had done nothing pretty much, and was just barely above the cusp of a penny stock. And this is when people started. And the biggest thing about it too was all the massive institutions, your massive JP Morgan banks, things of that nature. They had opened huge short positions against it. So a short position is like, hey, I think this stock is going to go down over a course of whatever, a year.
Kind of like a bet almost.
It is a bet.
Yeah.
It's a derivative. It's an options trading.
Okay.
They open a massive short position. So as the company's stock price goes down, your position profits on the other end. And a lot of times too, when people see J.P. Morgan, a lot of these massive corporations open short positions against these companies, it's like, oh, these are the pros. They know something I don't. I'm going to sell.
Sure.
Which then helps them even more.
Yeah.
And which that's a whole conversation. That's such a messed up system. But anyway, they had realized, there was like 5 or 6 different hedge funds that had tens of billions of dollars of short positions on GameStop, pretty much squeezing it. Well, then all the retail investors, you and I, everyday people, roaring kitty, he gets in here and people will start like, you know what? I'm tired of being beaten down and it's not a fair game.
Right.
We're going to start buying this thing up. So people dump everything they have into it. I don't know. The movie is really, really good. The profanity's pretty bad in it, which is super unfortunate, but it's called Dumb Money, and it's
I've heard
got
of that.
great actors in it.
Yeah, I've heard of that.
And it pretty much depicts this whole situation.
That's interesting.
So then, like, every day that this stock would hit new highs, these hedge funds would be losing billions of dollars every day.
Sure.
And it was just kind of like a slap in the face, like trying to take some power back. Now, what had happened then, as you start to roll on, as one does with American greed, or just greed in general, people finally started to liquidate and say, you know what, even I think like a $10,000 position turned into, I don't even know, a couple $100,000. Like
which if you see that, you're like, oh, I'm pulling out.
You would think, right? But then people are like, no, we can't. That's called diamond hands, right? it's we're gonna keep holding in and screwing these guys over,
Sure.
Until they break. Yeah, and the hedge fund just kept buying more and more. But then what ultimately happened, as it does with our government and especially larger institutions, whenever people ended up going to sell, finally, it was all on Robinhood at the time. Well, Robinhood, they claim, allegedly, which they ended up getting sued for it,
Really?
they froze all trading.
No way.
So, like, yeah, you couldn't sell any of your GameStop positions because it allowed the larger banks to cover their positions on the back end. Sell some things, buy some things, and then it was just a mess. So then, finally, as you can see here, people started to liquidate, and yeah, I would say I don't really know. There were people that held on to the end and ended up losing it and it going back down to zero. I think that Roaring Kitty guy, he sold probably a third of his position, but still made $25 million, whatever. But yeah, super interesting scenario. And then there was it was last year or 2 years ago, 2023. You see this little dip here.
Yeah.
And then it shot back up again. Or it's 2024. He resurfaced on on Reddit and did the same thing and had a little bit of spurge, but
not to the same effect.
Yeah, at our firm we cleared through Charles Schwab, and at that time I was a trader for our firm, and I remember I just had a couple clients calling in and wanting to buy in, but even Schwab had halted trading. So
Really?
They just didn't want it. It was that and AMC because it's the same principle, right?
Sure.
Not a lot of people are going to the movies,
So like companies like Schwab or like Robinhood, they were kind of supporting the large institutions.
Yeah, because there's a lot of I would say not Schwab in general. They were halting trading because it was like such a high frequency of people calling in, and it was one of those meme things. Whereas Robinhood, I mean, it was just wrong and illegal. And that's one of the reasons why I don't use Robinhood. They a few months ago, or I don't know when it was, when XRP.
Oh, that was so
spiked.
frustrating.
Exactly.
I tried to
It's the same
buy
thing.
and it wouldn't let me.
Exactly. So it's the
Yeah.
same. It's the same scenario.
Yeah, Robinhood in 2021 was the Wild West.
Yeah. And even most recently with Ripple, people tried to buy XRP and they had halted trading so that the large banks could cover their positions in time. And
It was so stupid. I
Yeah.
was like, I could have made so much money off of that.
yeah.
Huh.
Yeah.
That is interesting. So how would you recommend someone?
There's the AMC spike too.
Oh, yeah.
Oh yeah, that's like the same time period.
Mm-hmm.
Was it the same kitty guy?
Yeah.
Okay.
Yep.
That's interesting.
Yeah. So it is funny what and that's how the market is today. Like when you go through college and you're learning kind of the ropes, what a lot of people will do, some people subscribe to different methods, but there's technical analysis where you're looking at what are called Sharp ratios, earnings per share, looking at the data to say, okay, based on this company's data and all these ratios, this is where the stock should end up if they continue to go this way, either up or down.
Mm-hmm.
This is what makes sense, and it used to be like that. And then in today's market, you could have a terrible balance sheet for a company, not even making money, showing a net loss of $300 million, and the stock is soaring because our president mentioned it in a press conference.
That's the stupidest.
So it's really hard. You have a lot of hedge fund managers, money managers, like Michael Burry is one. He's the one that predicted the housing crisis, and he closed up shop because he would open these massive short positions against all these AI companies because they're so overvalued and trading 40 times their multiple.
Right.
And yet the price of the stock still increases, and so it is frustrating. It's just, you never know what's going to happen. It can turn on a dime. It's fun. I don't always enjoy it, but it is fun.
Yeah.
So, but our firm's philosophy in terms of investments, I think just me being younger and raised in this Robinhood era, I do enjoy the stock picking side of things. I have an account that I do it in just for fun. I've got clients that if they have extra fund money or whatever, and they are okay with the consequences, I'll stock pick for them. I enjoy doing that for fun. But as a whole, and the data does back up this philosophy, it's really low-cost index funds. And we have a bunch of models built out for people, some exposure in international stocks, which are also what are called exchange-traded funds, or the index funds we use. And it's not sexy, but it really works in terms of simplicity. We rebalance every quarter, which means like as markets tend to run, things go up and down, things get out of tolerance. So if a client is in a 60-40 model, 60% equities, 40% fixed income or bonds, at the course of a year, it might start like that, but at the end of the year, it might be 70-30. Our trading team will go in and they'll buy and sell necessary portions and get it back to that 60-40. So from a high-level view of our firm's investment philosophy, we usually use those index funds. We do have clients, too, that get full trading authority on their accounts, and they'll try to buy and sell. But we've got an interesting poster in our office that shows the annual or the average rate of return that an investor has had over the last 25 years, stock picking, compared to what it would have done if they would have thrown it in an index model, low-cost index model. And I think the average return after taxes and fees for a stock picker, annual return is like 3%.
That doesn't surprise me.
Yeah. Like you would have been better off throwing it in a treasury, a T-bill. So over a shorter period of time, it might work out. But over a 10, 15-year period, I don't know about you guys, but I'm not looking to retire in 15 years.
Right.
I don't know. We'll see.
Okay, so generally for people around our age, which one would you kind of lean, like, to advise them? Would you say pick more index funds and ETFs, or would you do more stock trading? Like, I guess which is...
Yeah, it comes down to three things. I would say it depends on level of risk that someone is willing to take. Like, hey, stock picking, it's one step above gambling. Maybe. Depends on how much time you want to put into it. In this market, it feels like that.
Oh, it definitely is.
Now, whenever I was like 5 or 6 years ago, I had invested in Airbnb, but I had seen that they had a ton of debt. It didn't look good, so I got out. But it's probably just luck, right? So I look at a few different things. Pretty much debt to equity, what their free cash flows look like for companies. But at the end of the day, it's really just, I say for retirement accounts, or what are called qualified accounts, I don't really advise, or even myself personally, I'm not actively trading in those. Mm-hmm. I've got low-cost index funds. I've got a system in there. I might have a few individual positions that I believe, hey, over the next 30 years, this company is I'm not going to sell it. So I'll have
Sure.
those in my Roth IRA.
And
So it
are
can
those
continue to grow
typically
tax-free.
like more niche companies, or are they like S&P 500
Yeah,
companies?
it depends. What I'll see too is a lot of people will have all these, like you'll have your individual NVIDIA, Apple, Amazon, all these large cap companies or stocks, but then they'll also have a decent amount of the portfolio in the ticker for the index fund is SPYM. It's the S&P 500 State Streets.
Okay.
And I mean that the S&P itself is already over. It's a weighted index, and AI and the Mag 7 the Mag 7 alone make up like 37% of that weight of the
Wow.
entire 504 companies that are in it. So if a few of those have a bad day like they've been having,
Mm-hmm.
it's going to be a red day for that ticker. And then you've got people that have the individual positions and the ETF, which those individual positions are in here too. So you're pretty much over concentrated in those.
Right.
What a lot of people don't realize.
Yeah. That's what I was doing. Like I had a good amount of Tesla, and then I
Yeah.
had some of the Nasdaq, and then I had
Yep.
the S&P 500. And I'm like, I
So
got to
you're
get rid of some of
triple.
this Tesla.
Yeah.
So like,
Yeah.
I got way too much riding on this one stock.
Yeah. So
So what's your favorite way to diversify away from? I guess those are a lot of like technology companies.
yeah. And I think tech has been a great investment for the last 5 to 7 years. Moving forward, people are starting to realize the uncertainties behind it, the volatility that it brings to the market. There's just so many uncertainties. And back to your past question. So for like qualified accounts, it's usually, and it is a little tempting. Like, oh, why don't you have individual positions in a Roth IRA? So if you're trading them, it's tax free. That is a good argument, and I think that's a good way to go about it. The only drawback that I see with those accounts is for a traditional and a Roth IRA. Obviously, one's tax deferred, one's tax free.
Yep.
You can only put in $7,500 a year into it, which isn't a small amount of money, but it's definitely restrictive, and then you can't move it around. So that's where I do a lot of my just for fun individual trading if I feel like it in a brokerage account where it doesn't have any limits on what you can throw in, what you can take out. The only taxes owed on it are short-term or long-term capital gains depending on how long you've held the position. So I would encourage young people to just start the Roth IRA, especially lower income phases. It might not seem like it, but tax rates are the lowest they've been since World War II.
Really?
Yeah, historically. You know what you're getting in today's dollars and then what you're paying in taxes today. Your longevity for career working or earning years is, I mean, you guys are what, 20?
Yeah.
Yeah, you've got 40, 45 good working years and earning years. Whereas assumingly, you progress in your career, you make more money, things start to happen, you're going to be in a higher tax bracket. So it's so crucial to start building that tax-free bucket as soon as possible, especially if you're in a 10% income bracket, working part-time in college, even 12%, right?
Right.
So I think it's crucial to get that bucket going. Anything above that, I don't think it makes sense to have a traditional IRA open for early. It just depends. But also taking advantage of your retirement plan at work if you have one. I know part-time they don't really offer that. Some companies do.
They
but
don't.
Yeah, but taking advantage of that, see a lot of common mistakes of people thinking that they're maxing out their 401k, but in reality they're just getting their match, which is just 4%. They're contributing $4,000 a year when they can put in 24,500.
Sure.
So, yeah, that's kind of where I'm at in terms of. I don't think it's a bad thing to experiment with individual positions and trade positions, but you have to think, okay, what's going to be the use for this money? You really have to earmark each account as a bucket, right? So, for your Roth, I mean, you can pull your basis out and what you've contributed to it, tax and penalty free if you need to use it. Earnings will stay in, but it's an individual retirement account, so essentially going to be using that later on, where you can have that brokerage account super flexible, where you can still get investment growth, but you can still pull it out if you need to.
It's worth a lot to be able to move your money between accounts. And
Yeah,
such.
flexibility is huge.
It is nice.
It is.
Yeah,
Yep.
for sure. So, back to my other question. How would you recommend to like diversify away from like technology heavy companies?
Yeah,
Or, I guess like the S&P 500.
Yeah, I think it's important to be invested in our domestic economy. The one thing is how the market is set up too, because you see people at times saying, "Hey, you need to have a percentage in large cap, the large companies, mid cap, medium sized companies, small cap companies." But what a lot of people don't realize is a portion of the mid cap funds are also in the S&P 500. So as they grow and progress, like your Apple started as a small cap and advanced through the rings, right? But there are some mid cap companies in small cap, so there's a little over concentration there. I'm a huge fan of small cap. I love small cap companies. If I've got individual stocks, I tend to favor trying to find some of those that
Really?
are kind of in the startup phase, starting to get their legs under them. I'm a big fan of small cap. It's performed pretty well over the last few years, finally. So I think the way our portfolios are set up, I think we tend to have around like 39% in large cap, maybe anywhere from 8 to I kind of favor 8 to 10% in mid cap, and then even 10 to 12% in small cap. 20 to 25% international markets. International was beaten down pretty heavily over the last probably 15, 20 years. But I would say in the last 5 years, they've made a comeback. So your international companies are pretty much, you've got two large markets. You've got developed world and then emerging markets, and they're both international.
Okay.
And with those, your developed markets is going to be like your Germanys, your larger European countries that have been around for a while, established themselves. Your emerging markets are going to be your more juvenile, just kind of figuring it out markets, but have promise. So like Brazil, Argentina. Brazil's got a great agriculture economy because they pretty much have 4 different harvests because weather is good down there all the time.
Interesting.
So they've got 2 separate harvest seasons. So, but over the last year, like last year, developed markets returned 37% and emerging markets returned 40%.
Oh, wow.
So it's like, okay, the U.S., we did okay, but it was like 17% large cap return. It's a good piece of the pie to have to diversify away, especially most recently with geopolitical tensions in Iran, and you just don't know what's going on. It's a good inflation hedge too, especially if inflation's super high here, which seems to be the case. And yeah, I talk to people a lot that are especially older that are anti-international, not supporting anything but the U.S., not giving money to China.
Yep.
All right. Well, I see where they're coming from, but there's just a lot of data that backs up having around 20 to 25% of your portfolio in some type of international market tends to work out or be close to the optimal portfolio.
Yeah.
So
yeah, that's interesting. I don't have any international funds.
Yeah.
I guess, would you recommend? Is there like index funds for that?
Oh, yeah.
Is that the best way to go
yeah.
about it?
So
like I'm not looking to like put a ton of time into it, and so like
Yeah.
picking out stocks. And
yeah,
stuff.
and so SPEM is a ticker for the emerging markets for State Street. SPDW is their developed. VEA I think is Vanguard's emerging market. I could be wrong. VO is their developed world, and that might be small cap. I don't know, but yeah, all those large Vanguard, State Street, those larger institutions that pay people to manage the index funds. Yeah, there's great funds out there.
Okay.
Very inexpensive. That's also my other hill I'm willing to die on is there's so many funds out there, especially mutual funds. And that is one thing you have to be aware of too, is just what you're paying and what's called an expense ratio. A lot of these funds can have these high expense ratios that you don't see.
Right.
You're paying it on the back end whenever it's
Like
traded.
Mutual funds, you're saying, right?
Even individual stocks
really?
have expenses on them depending on what type of class of stock they are. So there's Class A. There's also Class B and Class C. Depends on what commission is charged. There's like sales, like Schwab will charge a sales commission or things for individual positions. But yeah, your mutual funds and your index funds are going to have expense ratios, which is pretty much paying the fund manager for managing the fund. One of the most useful tools that I use in a prospect meeting, and you could even pull it up here, is it's on Morningstar, and if you look up SPYM.
I think I've heard of this. Sounds familiar.
And well, that's loading too. So if you scroll down, and there should be like a Morningstar link. Maybe the second one, third one. Right there. We'll try that one.
Is Morningstar a good place to get news?
Yeah, they're one of the best. They've got great data research. The people that contribute to their data research, they're incredible. So when this performance loads, yeah. So if you zoom in a little bit, Seth, thank you. So the red line is there's three different things being compared here. So the red line is the mutual fund, and that's going to be an actively traded mutual fund. So there's two different types. You've got actively managed mutual funds and passively managed.
Okay.
Actively it's pretty much in the word, they're actively trying to outperform the benchmark. In this case, for a large cap mutual fund, it's going to be trying to outperform the S&P 500. That might be by 0.5%. That might be by 10%. But what investors don't realize is they might get their statement and say, oh, wow, this fund returned 20% last year and the S&P only returned 15. Well, if you dig into the expense ratios, the fees, there's also a thing called a turnover. So how many times the individual stocks in that mutual fund basket are being bought and sold to try to realize gains, realize losses, outperform. It's very, very expensive from a tax and fee standpoint.
Sure.
And we've had clients transfer in from previous firms, and they've got these actively managed mutual funds in their brokerage account. And one thing about these actively managed mutual funds is they distribute profits at the end of the year out of the fund, whether you like it or not. So if they had a gain, they're going to distribute it in cash, and then the client it pretty much shows on a transaction sheet like it looks like as if they would have sold the position, and they have to realize a capital gain on it and they owe taxes.
Instead of reinvesting it.
Or just holding it in.
Sure.
Yeah, exactly. So that's why you never have an actively managed mutual fund or brokerage account. Never. No. Okay. And there are some caveats to that, but just high-level view, bad idea.
Generally speaking.
Because a lot of these funds are managed by these high-rise apartment owners, graduated from Yale, all these Ivy schools, Harvard guys. They come in and they have to pretty much have one job to outperform the market. Well, they also live in New York City. Like, they drive the fancy cars, right? They have this lifestyle that they have to uphold, and that's not going to come out of anyone's pocket but the investors.
Right.
So they charge a super high expense ratio on the back end. Taxes and fees come out of that. So they might return a gross 20%, but after taxes and fees and after the expense ratio is taken out of that, it might net 13. You know what I mean? So like,
you'd be better just putting in the S&P 500. Exactly.
And in an index fund. So this is what this is showing. So the dotted line, the yellow line is the S&P 500, the index. That's the benchmark.
Yeah.
That's what both of these funds, the dotted index fund, that's what it's going to try to mirror. Not trying to beat it, just trying to match it.
Sure.
That's what an ETF does. Just trying to match it. The red line is the mutual fund. So as you can see, you start out, this is 10 years ago, you put 10 grand in, you don't put any more in. This is just how the market has returned. As you can see, over a 3 to 4 year period, not much of a difference. You wouldn't notice a difference. But as time goes on, that difference and that gap between that actively managed mutual fund and even the index, there's a big gap there, and that is that taxes and fees. That's that difference there.
Okay.
So, yeah, I mean, cool. You put in 10,000, 10 years later it's worth 35,770. I would be super excited to see that until I look, oh, well, I could have put it in this thing
and made $12,000 more.
Exactly. Yeah.
Or $9,000.
$9,000 more. And that's just over a 10-year period. Imagine what a 10, 20, 30. So that is our approach. This is kind of the data we use to fall back on. I think it's like maybe 7 out of 10 money managers, actively money managers, outperform the market gross. 10-year period, it goes down to probably 5 out of 10. Or not 10-year period, 5-year period. 5 out of 10. 10-year period is probably closer to one or two.
Oh, shoot.
That continue to do it.
Yeah.
It's insanely hard to do it once, almost impossible to do it consecutively. So.
That's interesting. Hey, Bert, what time are we at? Okay, yeah, we should probably let's wrap up this episode, and then we will continue again.
Okay, sounds great.
Sound good? All right, see you guys next week.